Good morning, everyone. You all have seen the statement, I presume, so I'm not going to read out anything. I'd be happy to take questions, and my colleagues here will also help me answer. Alpana, would you like to choose?
Good afternoon, Anirudh here from ET now. So just want to firstly understand the SLR cut fully, and given the fact that the last time you came up with an SLR cut, a number of bankers did not pass that on. The general understanding is that the SLR cut would infuse some money into the system and therefore bring down the cost of credit. That doesn't seem to have happened in the last couple of months. So if you could explain to us how this would go.
See, the idea behind the SLR cut is if the government finances are improving and the government is on a fiscal consolidation path, we can afford to liberate more sort of access to government financing and make it possible for the private sector, for the public sector firms to get access to that financing. Now, they may not need it right now, but we're hopeful that as the economy picks up and credit growth gets stronger, the banks will be able to use that space to lend to the productive sectors of the economy. What the cuts do is they create that room for the banks to plan, for the sort of borrowers to anticipate that money will be available as needed, and also for the government over time to take that into account as it manages its financing. I think the best time to do these cuts is when credit is not, credit demand is not so strong that the cut suddenly converts into a substantial increase in credit demand and a substantial shift away from government bonds. In fact, as many have said, the banks today have surplus SLR. So we think this is more about planning rather than about immediate effects, and therefore I would not anticipate large effects in the market today, but I think it would help the market going forward.
Governor Subhashi from Reuters. I wanted to understand the liquidity management that framework that you're trying to kind of accommodate in the policy. What exactly is the RBI's thinking on liquidity? When you were saying that you will review the liquidity management framework, what does it exactly mean? Because apparently the recall rate has been oscillating between 9 to 7% in a wide band for quite some time now.
Yes, we have looked at those oscillations, and as we have said in the past, we are trying to keep the rate closer to the 8%. Now, some of those oscillations are because of substantial and unanticipated variations in government balances, and we try to work with that, but that does create a certain amount of volatility. As you know, there are increases in balances before tax dates and so on, and some of that you can anticipate, but the size sometimes is not fully is not easy to anticipate. Even spending is sometimes hard to anticipate. What we're looking at is the possibility of doing more frequent term repos, of shortening the maturity of term repos, and perhaps also thinking about the timing of the auctions during the day so as to minimize volatility. Now, to do this in a reasonable fashion, we are doing the analysis that is necessary, and hopefully within a very short period we will come out with any changes. I'm not saying that will necessarily be changes, but these are the things we're looking. Unlimited extent, you remove all volatility. The whole idea was to move away from that regime to go to a regime where liquidity was auctioned for the most part. We have made that transition. Now we have to work on fixing some of the issues that arise, and we will do that.
Could I just add something to
yes.
that? Just a couple of points. One thing to notice is that in July, the average call volume has come down by 40%. So it is a thin market, and therefore, as you know, in a thinner market, volatility is amplified. The average daily call volume has fallen from 16,000 crores to about 10,000 crores. Secondly, even by the standards in the past of fluctuations in government balances with the RBI, given the late budget and the fiscal deficit target that the government has laid out, in July, the turnaround in these balances were of the order of 90,000 crores. So these were special circumstances, both from the viewpoint of the volume and the government balances. The third factor is that we find that the call money market is highly skewed. There are about 4 or 5 banks who are perpetual users of this, with a slight odd variation in that. And therefore, looking at these microstructure and the overarching environment provided by the government change in cash balances, July was a particularly peculiar month. Thank you. No, just the change in government balances. Yeah.
Good morning, Governor. Saloni from Bloomberg TV. So 2 questions. First, on the fiscal deficit front. 2 months down, we've already exhausted 56%. Are there any worries on fiscal slippage? Do you think there will be a fiscal slippage? Is the 4.1 number feasible? Second question on the inflation and rate trajectory. In June, you mentioned that if the economy stays on this course, further policy tightening will not be warranted. This time, you're saying that we are keeping a watchful eye on inflation. Given the fact that 2009 we saw the worst drought in almost 37 years, we are way off the 2000 mark as well.
First drop in?
On the drought front, sir.
Drought.
If we don't see astronomical rains in August, we're going to end up on deficit monsoon. How do you see the rate trajectory panning out?
Okay. First, the market seems to have read our previous statement and tried to put an emphasis on certain words and de-emphasize certain words. As I read it, it was if the economy stays on this course, further policy tightening will not be warranted. In other words, if it does move away from this course, tightening will be warranted. And on the other hand, if disinflation adjusting for base effects is faster than currently anticipated, it will provide headroom for an easing of the policy stance. So I think it was two-sided. If it moves off in the upside, we will tighten. If it moves on the downside, we will be able to loosen. If it stays in the path, we will stay with where we are and adjust appropriately. I don't think our stance has moved from where we were last time. I think we see the short-term risks as being more balanced than they were last time. There is the issue of the monsoon, which you talk about, and we have to wait and see. We're not weather forecasters. We have to wait and see how it plays out. Let me emphasize that a below par monsoon doesn't necessarily mean significantly below par production. It depends on where the monsoon is below par. And second, significantly below par production doesn't necessarily mean higher food prices. It depends on food management, how much we allow in terms of imports and so on. So there is no one-to-one correspondence between all these things. The government has stated quite frequently that it is keeping its eye on food production and taking steps, and we have to wait and see how that plays out. I think what we are saying is that if disinflation proceeds as warranted, we will eventually have room to cut rates. Now, I want to emphasize that the RBI in no way will hold rates high any longer than necessary. There is a path we are trying to achieve, and we want to achieve that path. We're not against growth, but we do think that growth will be most benefited if we disinflate the economy and we don't have to fight this fight again. Let's fight the anti-inflation fight once, and let's win, and that will create the best conditions for sustainable growth. And I think the government, which has a long-term, a long horizon in mind, given that we just had elections, is on the same page, that let us bring inflation down. Of course, government has its role cut out. We have our role cut out. On the fiscal deficit, I think the government, the past government and the current government have stated again and again they are on the fiscal consolidation path. I don't think there's any reason to doubt it.
Morning, Governor. A definite addition in this time statement is para 9 perhaps, where you are reminding us of the next target of the Reserve Bank, the balance of risk around the medium-term inflation path, and especially the target of 6% by Jan 2016 are still to the upside. You didn't remind us of this in the June policy. So are we to understand that, therefore, one shouldn't be looking at this fiscal year for rate changes because the ultimate goal is 6%? What was the purpose for putting that statement there? And also to add to what Subhashri asked you, are you contemplating any change to that 0.25% money that is being available in the fixed rate one-day repo? Because the market's reading appears to be that because that is too limited and most of the money is available in the variable rate, 7-day and 14-day window, the call rates are volatile. So will there be any rethink on that distribution of money in the repo windows?
Okay, let me start with your second question first. At present, we are not focusing on that 0.25% availability. I think what we need to do is make sure all the other instruments that we're using to manage liquidity work well. That is not to say that we will not focus on that in the future, but at present that is not our focus. On the issue of have we brought in new information, yes, we are 2 months down the line, and we're getting close to the end of the year when our first target has to be met. So then the question you're going to ask is, what about the second target? And so what we have to do is remind people there's a second target also, that it's a path. And we've kept saying 8% and 6%. We need to also be confident of reaching the 6%. So let us see how things go. I don't think we know how the disinflationary process will pan out. As I said, we have an anticipation of how it will pan out. We think the 8% goal is well within reach, modulo a reasonable monsoon and modulo reasonable oil prices. Of course, those things can be volatile. I think as far as the 6% goal goes, we have said the ban up, and there's also a saliency in vegetable prices. People see the vegetable price and think, oh my God, inflation is up so much because tomato prices are up 80%. So we have to be careful. I'm not saying we can be complacent about vegetable prices, and but there has been a seasonality every year around this time they pick up. So let us see. July vegetable prices look a little steeper. But let's see, as we go into August, September, and the monsoon news also comes out, I suspect some element of the vegetable price increase is tied also to the monsoon. Let us see how these play out. We're not overly worried, but we're not complacent about them either. We are watching them very closely.
Bijoy?
Bijoy from Cogensis here. A couple of questions, but first of all, a clarification. In January, when I had referred to the macro report as country cousin, you had defended it as being part of the family. Is it now a prodigal son? It's not part of the family anymore. Moving on to my question, are you treating SLR also in keeping LCR in mind? Because is it being treated as much as an LCR enabler as a liquidity tool? And just to supplement Lata ma'am's question, on 6%, your work actually starts at 6%. It's just a glide path. So would you want to think about 6% when you make your rate moves in the future?
Okay, I have to decode that a little bit. I'm not quite sure. So let me answer the second question, and then maybe Urjit or Deepak can answer the first part. On the second question, yes. As we move to liquidity coverage ratios and those become issues for the banks, we want to give banks flexibility. And also, I mean, to some extent, we have to reduce the kinds of obligations that are put on the banks because they are entering a more competitive environment. So given that, steadily we want to reduce those, consistent with the space that the government provides by rectifying its finances. So it's part of both the attempt to meet international norms on liquidity, but also removing some domestic constraints on the banks, given that they have to compete with other financial institutions in this market. First question.
We have moved regarding our publications and the supporting documents for the monetary policy according to what was in our committee report. And there we had said that we would have the equivalent of the inflation report or the MMDR twice a year. So that was accepted in April when we made the policy.
Supplement that. There are two things which used to be there, the MMDR. One is the projections, that anyway that we have brought it into the policy. The other component was the lot of, the surveys that we had. And we have conducted those surveys like inflation expectation survey, industrial outlook survey and all that. So that soon after we also, in a day or two, will be putting in public domain. So there is no loss of information that gets into the policy making here. Yes, those surveys will come out.
Part of the SLR being brought down because anyway the liquidity coverage ratio has to be maintained.
I thought I answered it, that we have in mind that we want to give banks more flexibility in meeting the liquidity coverage ratio. And so as we bring down SLR, over time they'll be able to make an independent decision on what they hold to meet the liquidity coverage ratio.
But is there some number in mind as to what will be
It's
the
early
LCR requirement for the system?
I think we are in the process of putting those out.
Yeah, LCR we have given. There also we have given the glide path type in the sense when it has to be reached. And by the time they're required to reach the LCR, SLR adjustments will also be there. That's what is Governor is mentioning. It should be consistent with the overall approach towards the fiscal consultation.
Now, let me emphasize, the prime factor driving our ability to reduce SLR is government fiscal balances. So we keep that in mind. The secondary factor is to give banks more flexibility from a comparative perspective, as well as from meeting some of these stability ratios. I mean, 6% is our ultimate goal for the foreseeable future, what we call the medium term. Long term is too long to think about right now. So let's think about 6%.
Pradeep?
So what is the kind of policy transmission that you are looking for? Because as a result of your cut in SLR, bond prices might actually fall. And the net impact on interest rate, where do you see it? Do you really see funds moving to the productive sector as you've promised?
See, we're trying to do management in a very difficult environment. Difficult in the sense that growth is lower than one would like it to be in the best of all worlds, while inflation is higher than one would like it to be, again, in the best of all worlds, right? So do we push growth even lower, or do we try and enhance the aspects of growth that can also help inflation? So one way of thinking about what we're trying to do is we're creating an environment where perhaps we can enhance the supply side without at the same time giving a too much, let me emphasize the too much encouragement to the demand side. So we need projects to be completed. We need infrastructure to pick up because they are holding back the supply side of the economy. So we need to create the environment for that to be possible, even recognizing that while you buy more coal or you put in more concrete into the ground, that will enhance demand. So these things can't be completely separated. But we are trying to ensure that the supply side is encouraged without providing too much of a fillip, given the growing demand, to demand once again and then creating more inflationary pressures. So it's a fine balance that we're trying to draw. And as often stated, we don't have too many tools. The interest rate tool is a very blunt tool. We're trying to use some of the other tools. Now, all this is being done at the same time as we have to recognize that the economy itself is changing. And we have to give space to our financial institutions to adjust to the new economy. And so when you think about an SLR cut, we could stay with SLR where it is forever. But that is an old obligation which puts constraints on the balance sheet of the banks. And so to give them the space to deal with the new economy, we have to steadily think about bringing it down once the government gives us the fiscal space. And that's what we're trying to do. So there are lots of moving parts here. And to see this only in terms of A or B is, I think, a little unwarranted.
So you don't really expect the loans to be cheaper for anybody because of the policy action you have taken, right?
No, the intent wasn't the SLR cut was not intended to make loans cheaper today. It was to give banks more flexibility on their balance sheet going forward as some of the demands on the banks pick up, as credit growth picks up.
So one more question, if you allow me. We are getting information that CBI has started collecting data on NPA and CDRs from various banks. Would you confirm that?
Do we have any information on that?
No. We know as much as we read in media. We don't have any specific information on it.
So no information has been sought from RBI as such?
As you mentioned, the information when it is being collected from the individual banks, and I think they will have more granular information. So that must be the issue.
Post syndicate, are you asking for any further information from the banks? I mean, is RBI seeking info?
Look, there is a inspection underway of Syndicate Bank, but I think one has to be very careful about extrapolating this issue to the entire banking system without without thinking further through it. It does raise troubling issues, this particular situation, and it is important for the law and enforcement agencies to ensure that full investigation is done, and I think they're doing that. I would emphasize that one shouldn't extrapolate from this to the entire public sector banking system and assume that all the problems in the public sector banking system are because of criminality rather than because of other factors. I think the balance has to be maintained, and we have to be also careful that while we do a thorough investigation and culprits are brought to book, it doesn't become a witch hunt, which then stalls the entire credit process. So we have to be careful, and I think the investigative agencies will do their job appropriately.
Governor, if I can just add to it, Bhupika from CNBC. Bankers tell there is a larger question of pricing of loans. We remember RBI had come out or had set up a working committee to look into this pricing of loans. There was no consensus that emerged after that. In the sense, RBI had not come out with final guidelines. Bankers say that probably that's something which could solve this issue, and so is that something that we could expect, that probably the transparency in pricing of loans and that could solve these kind of anomalies from happening?
See, it's impossible to be. The whole point about banking is about taking risks and using your discretion in taking those risks, right? You have to know how somebody you may trust a little more, because they have, there's some chemistry that works. That's relationship banking. So for the outside to dictate this is the price that you're going to have to charge in this case, takes the banker out of the equation. In that case, we might as well put a machine there and give loans based on the machines. And some machines do that, but it's basically for small loans. This is what's called credit scoring. But I think for some of these large loans, it's impossible to take out banker judgment. So when there is banker judgment, you have to be careful about what is genuine banker judgment and what is not genuine banker judgment. And that's, to some extent, a very, very hard thing to do. So I don't think the answer is to make all loans uniform based on some observable characteristics, because then you might make some very, very bad decisions because you're not using your feel, your intuition for the character of the borrower. Character loans are a big part of lending. So we have to live with this. I think this episodes of the kind that is alleged to have happened suggest that we need to look again at the governance of public sector banks and understand the deficiencies there and try and improve it. There are lots of highly qualified, highly reputable people working in the public sector banks. They shouldn't all be tarred with the same feather. We were, I think, lucky enough to welcome Mr. Mundra on our onto the RBI just a few days ago, and there are many people of high caliber there. And what we have to see is how to encourage them, how to give them the space to work, because they're working in the nation's interest.
Lata, can we bring back the attention back to the policy? Gabriel had a question.
Hi, good morning, Governor. Gabriel Senior from the Wall Street Journal. You're saying in your statement that you know that investor risk appetite has widened financial markets, and that has generated portfolio flows to emerging market economies, and that could always revert. Now, I would like to ask you, what is the RBI doing to ensure that there is no capital flight or leading to any slide in the value of the rupee ahead, and what you think are the main risks in international finance scenario, and the geopolitical risks that you mentioned in your statement? Thank you.
Right. First, in terms of what we have done, I think it's been a joint effort by the government and the Reserve Bank to try and improve the macro fundamentals of the economy. Amongst other things, the fiscal deficit has been kept on a glide path that has been suggested by the government. Second, the current account deficit has come down significantly since there were concerns last May, from about 4.5% of GDP on an annual basis to something closer to 1.5% to 2% today. Third, our reserves have increased substantially since then. We are in a much healthier reserve position. And fourth, and this I don't want to diminish, I think the expectation that we will confront and deal with inflation is much stronger now than it was earlier. And one of the big concerns investors have coming in, and I hear this frequently, is, are you going to take away the benefits from Indian growth from us by inflating and thereby depreciating the rupee? And the answer is no, we have no intent of doing that. We want to bring inflation under control and more like the inflation in other countries, so that the rupee is not seen on a continuously weakening path. So all these things are, I think, big differences from where we were in May. I keep saying in international fora, India is not a problem anymore. I think there's a perception of a problem. I don't think there was a real problem last year, but I think today that perception also doesn't exist. Perhaps the most important thing I declined to mention was the fact that we have a stable government. And political stability, to my mind, is worth a tremendous amount as far as the external situation goes, and that is a big change. Now, in terms of what risks, well, I will tell you that nobody in the world knows what will happen when the interest rate cycle changes, because there's been so much money flowing on the basis of interest differentials that are anticipated to stay that way for a long time. When the perception of interest differentials change and money starts flowing back, who is, in Warren Buffett's inimical phrase, who is swimming naked, we'll find out then. But for sure, I don't anticipate that it'll be us.
Okay, Mayur?
So this is Mayur from the Times of India. So you've taken a number of measures to promote the long-term bond market for infrastructure. In this context, wanted to know whether you feel there's a need to recalibrate the yield curve to make it more attractive for long-term investors, sort of steepen the curve a bit.
The question is suggesting I have a wand where I sort of move it up and move it down. Look, what we can do is really create a macro environment which is comfortable to all investors. And I see at the long end, perhaps the most important things we can work on is improving liquidity in the bond markets, as well as bringing down perceptions of inflation. both those things are the things we can work on. At the short end, smoothing out liquidity is important, and building out the curve at the short end is also important. We're working on all these things. If you look at the moves today, for example, reducing HTM, people say, why do it? Well, it will improve liquidity in the markets, in the bond markets, because banks will trade a little more. That will improve liquidity. That's a good thing. So when we take decisions, we're not looking at the immediate effect on any market. We're not trying to see whether we get the vote of approval from the Sensex or from the GSEC market. We're thinking about the medium to long term. How is this going to play out? Is it going to strengthen these markets? And that's precisely why the decisions we took today were taken.
Can we quickly check if there is a question outside in bar?
Sure, ma'am. Ladies and gentlemen, connected to the audio bridge, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Our first question is from Manju of DNA. Please go ahead.
Good morning, Governor.
Morning.
The global financial markets are exuberant and US is moving towards a higher interest rate. The quantitative easing is also on course and is expected to end by October. What do you think would be the impact on the Indian market? And also your outlook on NPAs and credit growth for the banking system?
So, sort of a version of a question I addressed, but let me see if I can say it another way. When interest rates start turning, I do expect that people will revisit all their investment allocations and try and figure out where they want to pull out from. I would hope at that time they would see enough signs in the Indian economy to understand that it probably is one of the better places to put your money at that point, and that we should not see as big a change here as some other places might see. But I don't think we can, as I said, nobody really knows how the money will behave, because some of it is based on short-term calculations and not necessarily on longer-term fundamentals. We have tried to immunize ourselves to that by pushing some of the money towards the longer end, but I do suspect that volatility, at least initially, will be widespread. But as people sit down and take a more balanced view, I hope they will see these differences. So over and above some volatility, I don't see a longer-term effect, given the many things that are happening in this economy relative to some of the things that are happening elsewhere.
Outlook on credit and NPAs?
Credit and?
NPAs. Yeah, NPAs.
NPAs we are working very hard on tackling over the next few days. I hope we will be able to announce some measures on ARC's asset reconstruction companies. I think the idea is broadly to ensure that financial assets are dealt with in a way to ensure the maximum value for the underlying real assets, and to put the economy back on track in terms of growth. So, if there are distressed assets, can we bring in new equity? If there is a restructuring that is needed, will the banks do that quickly? If there are assets to be sold, can that be done speedily? Time often is the most important thing. The longer you wait, the more distressed the asset becomes. In an environment where we see growth picking up, I think if we can deal with some of these problems and put these assets back on track quickly, they will add to growth, and the overall losses to the system will be substantially diminished relative to where they are now. So our main effort is to try and get movement on all these sides, and to prevent, in some sense, parking or neglect of these assets. And I think the bankers tell us that some of our measures since April, the large loan database, the move towards joint lending fora, are starting to work. There are some teething issues which we are dealing with, but it is picking up. So I'm hopeful that all these measures, together with growth is going to be the thing that lifts a lot of ships. Together with the tide of growth, I'm hopeful that the NPA problem will be diminished over time.
Okay, last question from this room, Govardhan.
So, good afternoon, Govardhan from Economic Times. taking that 6% is the new target that we have to look
It's not a new target. It's always been the target.
Okay, so that is the new one that we have to. And you mentioned about the government creating a congenial setting for steady improvement. And then you also mentioned that consumer and business confidence become aggregate demand will also strengthen, and the Reserve Bank will act as necessary. So that is that you are forecasting a kind of inflation to perk up if the demand picks up. Does that mean that the conventional down cycle is not going to happen as it being expected because of these factors?
No. I don't think one should make too many assumptions. I think what we're saying is that, remember, our whole path has to play out. It's 8% at the end of this year, 6% at the end of next year. We're confident we can get to 8, and we are at the current setting. We are also confident we can get to 6. Now, how the setting changes over time, we're saying depends on developments. If inflation comes down faster than we anticipate, the language we used in the last statement still holds. If it goes up faster than we anticipate, the language we used in the last statement still holds. So in a sense, I think all we're saying is there is a path which is not just the 8 next year, but the 6 after that. Both are part of our program.
And then you mentioned about the current account deficit improving after the relaxation on the import of gold. So the gold imports have shot up. Isn't it a worrying factor when it comes to the current account deficit numbers for the full year?
Yes, I mean, our intent is, and I don't think the government's intent is to sit on these special measures forever. But let us see as the economy improves, as exports improve, that will create room for unwinding these measures more. I'm not overly worried about the blip up in imports of gold, but we're watching that to see how that moves.
So on Andhra Pradesh, I believe the RBI had asked for the yield data, and I think the debt waiver kicks in if the yields are less than half of the average. So just wanted a status update, because going back and forth and we're not sure what exactly, because they have their version, the government there. So what is the status on Andhra Pradesh?
I think the issue, as you well know, is that certain election promises were made both in Andhra Pradesh and Telangana. Now, there is a RBI master circular which allows a certain category of loans to be restructured if a area is subject to catastrophic weather or other sources of damage which hurt production. And typically a rule of thumb has been that in such situations, if yields are anticipated to fall below 50%, the collector can declare a state of emergency, which also triggers, according to the master circular, the possibility of loan restructuring. Of course, loan restructuring is completely at the voluntary it's completely voluntary for the banks, but in such situations we afford that restructuring better regulatory treatment. They're not treated as NPAs. Now, what has happened in Andhra Pradesh and Telangana is, because of a variety of factors, no such emergency was declared, no request for this restructuring was made, and subsequent to that we've had the full harvest come in. So unlike the typical situation where the cyclone Phelan hits, nobody knows what the extent of damage is, you have to act quickly. In this situation we have the harvest after Phelan also. And so we've asked for those numbers, we're looking at those numbers. Prima facie, the sort of 50% criteria doesn't look like it's been met by any of the districts. Now, that's not a hard and fast rule, but it is a rule of thumb that we have used, or that's in the master circular. So we're in discussion with the government to say, where exactly is the distress? so that we can take a more reasoned and focused view. It doesn't appear to be that from the production data that the cyclone had widespread damage. This is not to say there may not be localized damage, which we're not picking up, but we need the government to tell us how a more focused assessment can be made.
Farmers are already not paying back. Andhra Bank reported a threefold increase in its agri-back.
We have been quite categorical about the dangers of talking about waivers, about putting the idea of waivers, because it creates the possibility that anticipating such waivers, both the beneficiaries, the ultimate potential beneficiaries, as well as everybody else who thinks there's a chance they might benefit, stop paying for fear that they will not benefit when the time comes. We have some assurances that whatever ultimate scheme is devised will not reward just the non-payers. That there will be a scheme which doesn't encourage moral hazard. But right now there is no sort of scheme on the table. I think there are statements, there are discussions, but nothing really has been concretized.
Thank you very much, sir.